No, I expect silver when you get up to 300 to 500, believe me, I'm going to be looking to take profits. But what I'm not going to do is put the money into cash, paper cash. I'm putting it into gold bullion, real money, unleveraged, and leave it alone. That's my idea of cash. Okay, silver has broken out technically. If you plot it, go back 10 years, for example, you'll see that when we do it a little differently than the ratio guys. We divide an ounce of silver into gold and we express it as a percent. Right now, silver is about 1.6% the price of gold. If you go back to 1980 when it was $50, it was 6.5% of the price of gold. Go back to 2011 when it was $50, it was 3.1% of the price of gold. And we're now at 1.6. So the price has blown through the range of that history. The spread is still very discounted, though in a positive trend, because when we plot it, it's broken out. It broke out last November versus gold. It said, buy me, don't buy gold, because I'm going to beat it. And it has done better than gold, and it will do better. We argue from a major technical point of view, but we also know there's fundamentals in play. Everybody does. I mean, for 4 or 5 years now, you've had a deficit production to demand. Use silver to meet demand. It's not meeting it. And demand is exploding. One of the factors is China solar production. They constitute like 90% of global solar production. And it's a hot demand subject. And silver is a component within that. Minor component, but still consistent, but needed component of voltaic cells that make up the solar panels. Now, and higher energy prices like oil is helping turn the public attention in the world to, hey, let's find an alternative. India, for example, is going very deep into getting into solar production for general power purposes. Get that. Silver is a monetary metal. You go back 3,000 years, it's money, okay? You can't forget that. It's always been. In fact, some governments have made it money. We've made it money at one time or another. So it is the baby gold. It's the poor man's gold, as they say. If you look at gold, go back 50 years when it was legalized here in the U.S. in 75, there have been multiple major bull markets. For example, after it was legalized, it was $200, and it went down to 103 by summer of 1976. And it went from 103, by 1980, it had eightfold gain in price. It was over 800. Eightfold gain. Think of dimension, not dollars here. Then it pulled back, and in 2001 and 2, it made lows around $265 an ounce for a couple years. After having been 850, it pulled back to 260 something and based. And from that 260 level, eightfold gain by 2011. Different time span, but same gain, eightfold, $1,920 peak. So twice in 50 years, it's produced an eightfold bull market under conditions that aren't nearly as fundamentally dramatic as what we've got building under our feet. Gold right now is only fourfold. Last bear low was in 2015 at 1,050. We're trading either side a fourfold gain. If gold merely does what it did before, oh boy, I'm going to do it again. Sort of boring almost. I'm going to go to $8,500 gold. That just replicates the two prior bull markets. Now, we've argued that that's not a target. That's just pointing out a fact. Don't look at the dollar value of gold. Look at the multiple gains it's produced on a percentage basis. Now, during that same 50-year period, silver stuck at the highs of 50. Gold made new highs in each bull. Silver would go up with gold, but it couldn't get through $50. What's going on there? How come silver can't do it? Go back and look at a copper chart. Base metal. Between 1970, 80, 90, 2005, copper was in a multi-decade range from 50 cents a pound to $1.50. So let's call it $1 average. For multiple decades, it decided in late 2005, no, I'm not going to stay in the old range. It quadrupled in price and got up to $450 within several quarters of having broken out through that multi-decade price range. And it did it on its own. It didn't have to have a massive commodity surge with it. Gold wasn't doing with it. The same thing copper did. And then lead did the same thing in 2007. After multiple decades of boring horizontal range, it quadrupled in price in a matter of several quarters and lived in a new reality after that. There were sharp drops, but never did copper go back to $1. It stayed in this range of $4.50 to $3 for a couple decades. Of course, now we pushed up towards $6. How come silver was stuck in a 50-year box? Copper wasn't, lead wasn't, gold wasn't, but silver was. Well, there are arguments about it being artificially restrained. Well, when a market makes a mistake, whether it's a bubble stock market top, goes too far, too long, when it compensates for the mistake, it often overcompensates. In other words, it has a tantrum in the new direction. It unleashes. In this case of silver, it's compressed for half a century in an unreality that's not comparable to any other metal. And so it says, hey, I'm out of here. Well, if you take the dimension of silver's range of the last 50 years, $4 lows 50, $4, call it a tenfold range. What's tenfold above 50? Okay. Now, if you take simply money supply, M2 chart, and go back to 1980 and ask yourself, how much has M2 grown since then, when silver was 50 then? Whoa! Or 2011 when silver was 50 again. How much is the money supply? If you factor that in, you're talking several $100 silver just to compensate for the decay in the money unit. Now, the other thing we've learned is when silver has a tantrum like this, and the run-ups to $50 were tantrums within the range, however, and copper, or the lead chart that I mentioned, they did it in a couple quarters. We find that this immersion into a new reality quite often doesn't take years. It takes a couple of quarters. It seems to be routine almost, in fact, that when you have a tantrum like this, you get it done quickly and very efficiently, overcompensating probably. Well, we can come up with all kinds of reasons, both technical and the monetary fundamental, for example, that says, hey, $300 to $500 is only fair priced. And the history of these kind of emergences of markets from old realities to new realities is speed. And couple that with the fact that we're in an ongoing monetary bull market anyway. So it's not like silver's having to fight a negative trend with gold. Gold's in a positive trend. Silver is just saying, hey, I'm going to catch up to you. In fact, I'm going to beat you in terms of gain. And it started that as well when you measure silver versus gold on a technical basis, which we do month to month. We had a breakout last November in the spread favoring silver over gold. Well, what was the price of silver last November? $56. Dec, Jan, Feb. Of course, by January, it was 120. And now we've got an average price of the last 3 months of 75 to 80, average of the up and down violence. Right now, we're trading around 74, I think. So anyway, a lot of factors say silver's broken out. It's got the monetary excuse. It has the fundamental excuse, and the technical scream at you that it's headed to a new reality. So that's why we come up with that number. Silver miners, we got to look at silver first. Silver has broken out technically. If you plot it, go back 10 years, for example, you'll see that when we do it a little differently than the ratio guys. We divide an ounce of silver into gold and we express it as a percent. Right now, silver is about 1.6% the price of gold. If you go back to 1980 when it was $50, it was 6.5% of the price of gold. Go back to 2011 when it was $50, it was 3.1% of the price of gold. And we're now at 1.6. So the price is blown through the range of that history. The spread is still very discounted, though in a positive trend, because when we plot it, it's broken out. It broke out last November versus gold. It said, buy me, don't buy gold, because I'm going to beat it. And it has done better than gold, and it will do better as we assess it. Well, that means probably the silver miners will also come from their undervalued level to gold miners and reassert themselves. And we see the technicals for that too when we plot spread charts. For example, SIL, the miners ETF, silver miners, versus GDX, the gold miners ETF. That has broken out favoring silver miners over gold miners, meaning we're going to outperform you now. It's a technical decision, but it fits with what silver just did versus gold. And they're still historically very much undervalued to their metals. The miners are dirt cheap compared to that which they get out of the ground. True with the gold miners versus gold. They've emerged into a positive trend versus gold. And it tells me that investors that are only now getting into the monetary metals, and it's probably a lot of them came in late last year and got whacked by coming in late. If you come in late, you're going to get whacked. We finished our buy signals back last November at $56. That was our major final buy signal. And right now, we thought we'd get a correction. somewhere in the middle of this several quarter surge. And sure enough, we got one bigger than we thought and a little bit sooner than we thought. We thought it might occur in February or March. Instead, it occurred from a January high. But each of these explosions that we see in these markets, like copper did, or lead did, or that silver did, running up to 50 back in 1980, or running from the teens to $50 in 2000, there was a midpoint correction in each of those. Midpoint on the clock, that is, where you got a stumble and it looked like, oh gosh, it's over. But it was only a midpoint. And I think that's what we've just seen. And I think we've seen the low in that correction, which occurred several weeks ago in both metals. And I think we're in the process now of moving back up to challenge the highs of that range. And when that occurs and the public says, oh golly, that wasn't a top, expect an orgy on the other side. We're headed for a new monetary reality, or return to an old monetary reality. And that is, since the Fed was created and other central banks that have turned their currencies into unbacked pieces of paper, gold backed, not silver backed, in other words, fiat, it's competing degradation in money units. The dollar looks stronger than the euro sometimes, and then it looks weaker. Right now, it's in a bear trend versus the other currencies, as far as we're concerned. Dollar is. But it's real buying power is the issue, because all these currencies decay in value. And the problem with that is you continue to have boom-bust cycles in assets like stock markets. And when you get the busts, that's when you get frowns. And you get people say, what's wrong? How come we keep having this problem? And it doesn't take too much. Usually when you get enough pain, people say, well, I'm sick and tired of this. What are we doing wrong? And there's a growing awareness. You see it in China now, for example, in India, of, hey, maybe we need to go back to real money, gold-backed, silver-backed, whatever. And if you get into what we're thinking we assess is going to happen with the stock market bubble here and in Japan and even in Europe, they're not as much of a bubble as we are. But by the way, China's stock market is not a bubble. It's only double and a half where it was from 2009. S&P is 10 to 11 fold. NASDAQ 100 is 20-fold above the 2009 low. But when we get into that bear market, that's when you get the dark data points and you get human pain and you get people in the street hurt. Whether they got a retirement account or not, they're getting hurt. And that's when you get doubt and reconsideration and sometimes hands in the air. And that's when even intellectuals who've supported the Fed, academicians, the concept of a central bank, suddenly say, I don't know if this is working or not. And that already is, that thought process has commenced if you pay attention. It's especially the Mises Institute, one of the most potent think tanks in the country, has made a major issue about that. In fact, put a full-page ad in the Wall Street Journal like months ago saying, abolish the Fed.